Hi, good morning, everyone. I'm Darren from Investing Note. Thank you for joining us today. Today is the second day of Invest 360. So welcome all of you. So today's the topic for these sessions is are stocks prime for a rebound in 2021? And today we have James as our speaker for these sessions. So James is a product specialist at Share Investor and also the founder of smallcapasia.com. So smallcapasia.com is an investment blog which helps to uncover hidden gems, specifically in the small or mid-cap space. So let's say later, if you have any questions during the presentation, you can see a orange box on your right hand side. So you can just type your questions into the box. So we will have some time for the Q&A today. Okay. Without further ado, let's welcome James. Hello, James. Are you there?
Hi everyone.
Hello. Okay,
Hi,
so
James here.
I will
Yeah.
just pass the time to you.
Okay, sure. Thank you,
Okay,
Darren.
thank you very much.
Thanks. I'll share my screen right now.
Sure.
Okay.
Okay, it's clear.
Okay.
Yep.
Darren, you can see, right?
Yeah, I can see. Yeah.
Okay. So let me go back to. Give me a second. Okay. Okay. Hi everyone. Welcome to this webinar. Okay. My title will be "Are Stocks Prime for Rebound?" Okay. This will be to conclude the year 2020 and also to prepare ourselves for what's to come in the year 2021. Okay, so first off, just a quick disclaimer. Okay, views and opinions expressed by me does not necessarily reflect those of Share Investor Private Limited. Okay, the presentation is only for information purposes only and does not constitute to any investment advice. Please consult your trading representative before making any financial decisions. Okay, so going on to the agenda today, we're going to talk about the macro outlook in 2021. We are going to dive into three themes that are likely to play out, okay, in my own personal view, and also share across three stocks that stand to benefit from these three macro themes. Okay, the first one will be a renowned budget airline. The second one will be, US listed, okay, Berkshire Hathaway only REIT. The third one will be a leading agribusiness blue chip stock. And then lastly, okay, we will end off with the conclusion. So what are the key takeaways? And then move on to the Q&A session. So if you have any questions, right, you can leave them inside the Pigeonhole chat box, okay? And I will answer them towards the end of the webinar with around 15 minutes. Okay, so without further ado, let's jump into the presentation proper. Okay, welcome to a brand new 2021. Okay, so firstly, right, I just want to say that I don't have a crystal ball and I cannot predict exactly how the economy will do in the next year or so on going forward. Okay, but year 2020 has seen the global economy plunge into turmoil, okay, as the COVID-19 pandemic impacted all the whole world, okay, through lockdowns and, resulted in a very sharp drop in demand. So given the backdrop, right, we feel that the economy, okay, of 2020 will rise up again in 2021 with all the government support and the availability of the vaccines and all that. So, the economy will rise up again. And with that, right, I have three big macro themes that I personally feel that will happen, okay? And I want to share with you the reasons as well as the stocks that will benefit from it. So the first macro theme that we have is the rotation to cyclical sectors. So first of all, right, we need to understand what do cyclical stocks mean. Okay, cyclical stocks are stocks whose fortunes are directly tied to the state of the overall economy. So what do I mean by that? So that means if the economy is doing well, the cyclical stocks will perform well as a result. And some of the examples include, okay, right here you have the picture. The first one will be the real estate. So you have property developers like the city developments or capital land and all that. Consumer cyclicals. So one of it that I can think of would be the casino. So when you have a stable job, okay, or you have more cash to spend, you will tend to go to the casino to have fun and things like that. So it's part of the consumer cyclical. Of course, we also have the financial services. So these are the banks. Okay, when the economy does well, the banks will of course also lend more money and then profit more as a result. Okay, then moving on, we have basic materials, construction, and of course, because of COVID-19, the cyclical sectors also include the airlines and the tourism because they are in a very bad shape now, and then they are poised to recover based on this cyclical movement. Okay, so there are three main reasons why I feel that there's this cyclical rotation. The first one would be the vaccine. Okay, so the vaccine, right, is already coming to all the countries. Singapore has already seen our government people personnel taking the vaccines and things like that. So it will result in a reopening of the face-to-face sectors. The second one will be attractive valuations. Okay, this is in relative, to the very tech-heavy, growth focused US stocks right now. And if you look at it, if you compare, the cyclical stocks that we have in Singapore versus those tech stocks in US, you see quite a big gap over there. You don't need to even go down into the numbers or things like that. But if you can just compare these two segments, you would think that right now the cyclical stocks are trading at attractive valuations. And then the third reason will be accelerating GDP growth. Okay, so this will come from the government stimulus. And in the next slide, I will share with you, okay, all the government are pumping money into the economy, and because of the poor GDP performance in year 2020, year 2021 will see a sharp rebound. Okay, so just now I mentioned the government stimulus worldwide. And if you can see from here, right, the US, even though they are, giving a lot of stimulus and things like that, but it only constitutes to 18% of their GDP. Okay, of course, this one, the data is as of 21st December. So this does not include the upcoming plans of the another stimulus package by US. But if you see from here, Japan is actually the highest one. They are giving out a stimulus of 42% of their GDP. So the next macro theme that we have is low interest rates. Okay, if you are following the news, right, especially in the US, it's very clear that the US Fed has pledged low rates, okay, until 2023 or until inflation picks up. And the latest economic forecast, right, says that the interest rates will actually remain near zero to 2023. So what is the reason and the impact behind the low interest rate? Firstly, okay, you must know that the lower the interest rate, right, okay, the more willing people and businesses are to borrow money to make big purchases, such as houses or cars. That's why you can see that property developers are actually selling uh, more houses, more condos, when they say that the economy is actually doing poorly. But why is it that a lot of people are buying those condos lah and things like that? It's because the interest rate is expected to remain low. And then when consumers pay lower in interest payments, right, this gives them more money to spend, which can then result in a ripple effect of increased spending throughout the economy. Okay, but on the flip side, right, banks will earn lesser interest as a result. So that means if you think about it, um, if you notice, right, OCBC Bank, DBS, they have been sending out those email notifications that says, hey, we are cutting your interest rate because of what? Because of the low interest rate environment right now, and they are not earning that much compared to the last time. So this is the impact behind the low interest rate. Okay, the third macro theme that we have is actually this commodity demand boom. So what do I mean by this? Okay, but first of all, we need to rewind a bit. Okay, to understand why there's a demand boom in the commodities, you must understand it from the US side where they continue to print money. Okay, and for those people who are not aware of what do you mean by printing money, okay, the term means that the US Fed prints money or actually creates it digitally and then uses that money to buy bonds. The idea of this printing money, right, is to drive down interest rates and hope that people and businesses will borrow and spend more, and as a result, revive the economy. What is the result or the impact of this printing money for US country itself? So it results in the USD depreciation. Okay, but because by printing extra notes, right, the government literally increases the total money supply. So if you think about it this way, maybe I buy one McDonald's meal, okay, I need to spend $5 worth of money, okay, worth of the money in circulation. But right now I have $50. I have more money, but the same good remains the same. So as a result, right, when you have more money supply in circulation, it means that the money is worth lesser right now. And then moving from the USD depreciation, right, to the commodity demand, you must understand that there is an inverse relationship between the both of them. Why? Because commodities are largely priced in US dollars, and a weaker US dollar will result in higher demand because now they are relatively cheaper when you talk about them, like maybe in China, in Singapore, they see that actually now gold, okay, never mind, we don't talk about gold, we talk about maybe oil, or we talk about the soya bean, the grains, the wheat and all that. So they are usually priced in US dollars. And if the US dollar come down, right now maybe, okay, $1 equals to, I think, 5 RMB. So what if USD come down? USD come down may mean that, okay, now it's worth only maybe it's worth now 6 RMB. So now actually the China has more purchasing power to purchase the commodities. And if you see from the chart here, okay, this is the commodity index from Bloomberg. You see that from 2011, the index is actually at around 170. As came down all the way, okay, 2020 March saw their bottoming of around maybe 50 something, and it has rebounded sharply to 78. But it still has, based on this chart itself, it still has a recovery team whereby it will go back to the norm of maybe around 125, like that. Okay, so just to recap the whole three macro themes, right, in 2021. First of all, we have the rotation to cyclical sectors. So for this one, we are going to cover one stock, which is the renowned budget airline. Okay. For lower interest rates, we're going to touch on REITs, because REITs, as a asset heavy property kind of a stock, they will benefit from the lower interest rates because they borrow money to buy the properties. And for this one, we're going to talk about a special stock. Okay, this one is US listed, that is owned by Berkshire Hathaway. Hathaway, with all the stocks that they have, they only own this particular REIT. So later I'll highlight more. Lastly, for the increased commodity demand, we're going to talk about this leading agribusiness blue chip stock. So total, we have three stocks that we're going to cover. With that, okay, let's get started. Okay, let me drink a sip of water. Okay, so renowned budget airline. So how many budget airlines do you know in Asia itself? Not many, right? Okay, because SIA is not a budget airline and things like that. So today, the one I want to cover is AirAsia.com. Okay. AirAsia actually needs no introduction in Asia and ASEAN, okay, because it is the leading low-cost carrier and it serves more than 3 billion population over 6 countries around the region. But if you look at their corporate presentation, right, they actually have so-called expanded to 6 business segments. Okay, the first one, okay, I will just go through one by one. The first one is teleport. Teleport is their so-called the cross-border deliveries segment. Okay, whereby they move the cargo in and out of the different cities. Then we have Asia.com. Okay, they are going to rebrand as an all-in-one digital travel and lifestyle super app. Okay, so although they have done very poorly because nobody can fly, but they are slowly transitioning to a so-called super app, which I will cover more in details later. They also have the big pay, so this one is like the some sort like the remittance kind of a platform. Okay. Then next we have this Santan Food. Okay, Santan Food actually is derived from their in-flight food services. So last time, they like the SATS, the Singapore listed SATS. Okay, they used to have kitchens that cook the food, and then send over to the airplane. Then when you are flying, and then you can eat the meals over there. So they have decided to expand this one into like a restaurant whereby you can do franchising and all that. So their revenue actually grew 64% and 64% quarter on quarter and 86% year on year. So although this segment is rather very small right now, it is a catalyst for growth going forward. So AirAsia also have the big rewards. So this one is their loyalty platform. And then last but not least, they have this Our Farm. Okay, Our Farm is like a aggregator of the farmers in Malaysia together with SMEs. But this one is still a relatively very small segment in Asia right now. Okay, so I have gotten this image, okay, from their latest third quarter 2020 results. You can see the revenue part. Okay, revenue part, Teleport actually contributes to 55 million ringgit. AirAsia contribute very little, and Big Pay 4 million, with the others 12 million. But if you focus on the EBITDA, right, so the earnings before interest, tax, depreciation, amortization, right, EBITDA, the logistic, okay, the teleport segment actually contributes a positive 20 million. Okay, so called you can call it the profits. Whereas Asia lost 2.9 million, with the rest still loss making. So right now it's still if you want me to sum it up, right, AirAsia as a whole, the teleport segment is the one driving the growth right now. The rest is still at the early stage, but maybe they will have growth or long-term prospects ahead. So, okay, I want to just highlight this rebound in air travel. For AirAsia, if you look at their 5-year operating stats, they carried 24 million passengers in 2015 and 51 million in 2019. So you can see the very steadily increasing passengers carried. Okay, and for the RPK, which stands for revenue passengers kilometer, okay, this will be the number of kilometers traveled by the paying passengers. So this one is also showing a very steady increase uptrend. Okay, then now let's talk about the air travel. So air travel is like an undisputed trend, okay, whereby the passengers carried, you see from here, 1970s, 1975 all the way to 2019. Their the passengers carried right throughout the years have always increased. So it can show that air travel is a mega trend and it's not going anywhere. Even in, even with COVID-19, even in the years ahead, people will still travel because either be it for recreation or business purposes, air travel is a undisputed trend. And even the two recessions, right? During the Euro crisis in I think 2003 and the dot-com bubble bust in 2009, okay, cannot stop this mega trend. A lot of people are concerned about AirAsia and whether they can survive the downturn right now. Okay, so that's why I decided to focus on these capital raising plans. Okay, other than the cost containment measures like cutting the directors' pay, uh, cutting staff and things like that, like stopping any expansion, AirAsia is also eagerly raising funds. Okay, so they actually sold 32% of the Indian operations. They have also stopped the AirAsia Japan to reduce cash burn, dispose all their spare engines to raise liquidity, and as well as secure the loans from the banks. They also have plans to raise up to 2.5 billion ringgit and is on schedule. Moving on, I want to highlight about the ownership, okay, the ownership of AirAsia. You can see here, right, the shareholdings of the CEO and chairman, okay, Tony Fernandez and Karamuddin, right? Okay, they own a total indirect stake of 32.18%. So this one still does not include their 0.05% and 0.06%. So in short, right, they have skin in the game. So they want AirAsia to do well because they own 32% in AirAsia itself. So how about AirAsia growth prospects? Even if they can, go through the capital raising and survive through this down period, right? What is their growth prospects going forward? So I have taken their corporate presentation. Okay, this one is the slide that shows a couple of important highlights. First thing is the strong signs of recovery. Okay, although actually Malaysia went back to MCO recently. Okay, but just a few months ago, they are showing strong signs of recovery. There's a rebound in forward bookings, okay, across the region. So we are talking about across Asia and ASEAN itself. And Asia actually say that the profitability of their airline business will increase compared to pre-COVID-19 because they are doing all the cost containment measures right now. Okay, the reduction in cost because of leaner operations. And more importantly, right, okay, AirAsia is not just airplane, that allows you to fly anywhere. They under the leadership of Fernandez, okay, they are trying to transform into a travel tech company with two main divisions. So the first one will be AirAsia.com. So this one they are trying to make it into like a super app where you can book flights, tours, and even entertainment itself. The other one is Big Life. Okay, Big Life. If you read from their press release, they are going to transform it into like a digital arm, whereby they invest in many different businesses as well as their loyalty points platform. And if we talk about the valuation, okay, because currently they're making losses, P ratio doesn't make sense, okay, and their assets are also in their assets are literally their airplanes, so this does not make sense in the current situation. As a result, I have taken price to sales ratio, okay, as a as a gauge. And from what I can see here, okay, the price to sales ratio from FY 2011 to the current ratio right now, it is trading at around 0.6 times, okay, price to sales, as compared to around 1.8 or 2 times price to sales back in year 2011. And of course, you must also know that AirAsia has grown uh, quite big or significantly throughout the years. So if it were to just rebound, right, to an average of 1 times price to sales ratio, okay, that would be, I think, around maybe a 40% upside from here. Okay, then moving on, we want to highlight another stock which can benefit from the low interest rate environment. So this REIT is called the Store Capital. Okay, Store stands for single tenant operational real estate. Okay, so what does it mean? Okay, let's look at the profile. It is one of the largest and fastest growing net lease REITs. What do I mean by net lease? Net lease means that the tenant will pay some or all of the property expenses on top of the rent. Okay, so to put it into layman terms, for example, if you rent a room from the landlord, and then the landlord asks you to pay your utility bill, asks you to pay your handphone, I mean the internet, broadband usage. So this is what it actually means for the REITs itself. So this net lease, it is even better than just uh, the normal situation whereby the tenant just pay the rent. Okay, and it is focused on the service sector of the US economy. And more importantly, why I wanted to highlight this REIT is because Berkshire Hathaway owns a 9.8% stake in 2017. Okay, just a very quick background. It's listed 2014, and then Warren Buffett invested 377 million in them during 2017. Okay, they actually up their stake again. Okay, I think last year, 2020. So now currently Berkshire Hathaway owns 9.9% stake. Even after Stock Capital issued some capital raising. Okay, so to dive down into their asset classes, okay, six is predominantly a service-oriented REIT kind of a asset class, whereby you will see the everyday services like early childhood education, health clubs, pets, restaurants, and all that. And then they also have a retail as well as manufacturing. And from the corporate presentation, I just want to highlight a few important points. The first one would be the profit center real estate. Okay, what do I mean by this profit center, right? Is that when when you invest in when they invest in the tenants, right? Okay, when they rope in the tenants, they look for tenants that are making money off the real estate itself. What do I mean by that? That means, for example, if you talk about a doctor, right, opening a clinic, or opening a clinic, if they don't rent the so-called this property from Store Capital, they wouldn't be able to make any profits. So that's why they are called profit centers. And Store Capital is always on the lookout for profit center real estate. They have a 30-year leadership track record. Okay, this is a so-called a dividend growth REIT 44% dividend increase from 2014 to 2020. They have a very diversified kind of portfolio, 2,500 properties. So because they are focused more on those single tenant, very small kind of, uh, the properties in US, so they can have a very wide spread of different kind of properties. Okay, then moving on, just now I mentioned about Berkshire Hathaway. Okay, so I just want to share that, okay, why is it so significant that Berkshire Hathaway only invest in this particular REIT? So there are tons of REITs in US. Why is Berkshire Hathaway taking interest only in stock capital? You must understand that Berkshire, right, usually they have very stringent criteria. So some of the companies owned by them include quality companies or those with, you know, good brand mind recall, Coca-Cola, Apple, Visa, American Express. So this speaks volumes when, Berkshire Hathaway decide to invest, a significant 9% stake in stock capital. Okay, for REITs, right, of course, we need to talk about the capital structure. So for stock capital itself, their leverage ratio is 37% as of 30 September 2020. And their interest coverage ratio, okay, this is like an interest coverage ratio whereby you take the net operating income divided by the unsecured debt. So it's at a very healthy 7.6 times. And as I mentioned just now, US government will likely keep interest rates close to zero until 2023. So in a low interest rate environment, of course, it will benefit the REITs, because when you look at it, stock capital is borrowing money to acquire properties, okay, and current interest rates for them is around 4 point something percent, okay, and if there's a low interest rate, they are able to so-called what do you call that, renew their debt based on the low interest rates again. And some key things to note is that they have a 600 million multi-year revolving facility. That means they can tap it anytime. All their borrowing options are AAA, okay? So very good quality. And last but not least, their borrowings are long-term and fixed rate. Okay, then moving on to the growth prospects. Stock Capital has quite a strong business model, as you can see from here. They have a clause whereby they increase the annual rent, okay, and their capitalization rate, okay, depicted by the yellowish brown, okay, close to 7.8%, is always more than their borrowing cost. Okay, you see the dark blue one, the borrowing cost is around 4.4%. Okay, so they have always maintained it since 2017. Okay, they make sure that what they earn, okay, 7+% is more than their borrowing cost of 4 point something percent. Okay, so just want to highlight here, capitalization rate, okay, is an indicator of the property's expected rate of return. So you can treat it as like some sort like a net profit margin kind of thing. Okay, and people would be worried, like let's say in the age of e-commerce, right? How would it impact this REIT? So I decided to highlight this thing over here. Okay, they invest in the properties or in the tenants with the experiential components combined with strong online presence. And if you look at their industries over here, for their tenants, right, are usually very what do you call that? Heavy duty or asset heavy. Home furnishing, hunting, car dealers, farm supply, furniture stores. So for these big ticket items, right, the chances are that the consumers will tend to want to go down to the physical stores and have a feel and things like that. This is different from those grocery whereby you already know the brands, you just buy from there. But for this kind of the industry groups, right, it is important for them to have the physical outlets as well. So now let's talk about the valuation. Okay, when I grab this screenshot, okay, as of the September 2020, their price to NAV is around 1.5 times. Okay, although when you compare to Singapore REITs, the Singapore REITs always have very what you call that affordable price to NAV ratios as compared. But from this chart itself, 1.5 times is actually lower than the average since Store Capital has been listed in year 2014. And the last point I want to highlight about this Store Capital REIT is that they maintain resilient distributions even during the COVID-19 situation. Okay, so based on this distribution table, you see that year 2020, okay, during March or June, US is hit very badly, but they still managed to increase the distributions. And from the listing, okay, from their IPO in 2014 to 2015, right, okay, they have always been increasing their distributions on a year-to-year basis. So very stable and steady increase. Okay, then now moving on to the third stock to benefit from the macro trend. Again, this one will tap on the increased commodity demand boom. Okay, so this blue chip stock will be none other than Wilmar. So I believe a lot of people would have heard because Wilmar actually their share price shot up quite significantly over just the past month. Okay, just to go through a quick background on Wilmar, they are a vertical integrated commodity producer. So what do I mean by that? They actually have their supply chain from the origination. They do all the oil palm plantation, sugar milling, to the processing. Processing whereby they make them into raw and refined sugar, rice, flour, biodiesel, specialty fats, and things like that. And then they have the merchandising and distribution. So they will distribute all these food products. From here itself, the quick snapshot, over 900 manufacturing plants in 32 countries. Okay, so you can really see their scale from here. Distribution network, China, India, Indonesia, the three so-called the most populous countries in the world. Okay, and their workforce, 90,000 staff globally. Okay, if we talk about Wilmar, we must talk about their current subsidiary IPO. So this Yihai Carry Arawana. So okay, I'll just keep it short. YKA is also called Jinglong Yu in China itself. The IPO in, if I'm not wrong, is 15 October 2020. Post IPO, right, Wilmar owns close to 90% of YKA. For quick background on YKA, is a wholesaler of the food products. So Jinglong is one of their edible oil product. They are also involved in the processes such as oil seed crushing, oil refining, and all that. And more importantly, okay, did you know that YKA's IPO price is renminbi, okay, $25.7? Last I checked, as of 12 Jan, their share price have actually shot up to 121 renminbi. That is an increase of 471%. So this shows how popular this stock is in China itself. Okay, then I want to highlight something about the shares buyback. Post the IPO, right, of their subsidiary in October itself, you can see that Wilmar actually started doing a lot of shares buyback in starting from I think November, because you know they across the 2-year period they haven't been doing any shares buyback, but after the subsidiaries IPO, they actually did a very aggressive spree of their company's shares. Okay, then I wanted to highlight about the ownership. If you look at Wilmar, their top shareholders, right, are mainly those significant ones are mainly food processing or food production MNCs. The first one on the list is this Archer Daniels Midland. They own 24% stake in Wilmar. Okay, PPB Group Berhad, okay, Malaysian conglomerate with focus in grains and agribusiness. They own an 18% stake in Wilmar. Kerry Group, Ireland listed consumer foods and nutrition leader, own a 6.5% stake in Wilmar. You can see from the top 3 shareholders, right, they are all food processing companies. So even if you don't understand what Wilmar International does, right, you look from the ownership chart here itself, you can already know that these guys will definitely know what they are doing by investing in Wilmar, because they are all in the same line. And if they invest a significant stake in Wilmar, that means they are confident about the long-term prospects of Wilmar. So now let's talk about their growth prospects. Okay. Earlier on, I mentioned about the Bloomberg Commodity Index. Okay, they have hit a 6-year high on the vaccine hopes. So this will spur the prices recovery in commodities like palm oil and white sugar. And the just now I mentioned, right, the subsidiary in China, okay, is their proxy to the China economy. And right now, because of all the lockdowns across the whole world, it is vital that China move towards the domestic focus, and this will in turn benefit Wilmar as a result. So some other Asian countries, okay, are also seeing the easing of lockdown measures. So this will also pick up volume for commodity demand. Last but not least, the USD depreciation, like I mentioned, cheaper prices in relative, so that will lead to a further boost. Okay, one more thing to highlight: Wilmar will offer a special dividend of 6.5 cents, okay, in February 2021, so next month. Okay, valuation wise, I have grabbed this based on the June 2020. So their P ratio back then was around 12 times. Okay, just an important note. Okay, this is as of June 2020. So their share price has run up quite significantly over the past few months. So you should go look at their recent P ratio again. But other than the P ratio, right, I just want to highlight on the other part, which is how they were going to unlock the value, especially with the focus in their subsidiary. So YKA, I mentioned just now, okay, their market cap based on the share price of 123 renminbi is converted to Singapore dollars is around $137 billion. Wilmar owns 90% of EHI. Okay, so that will constitute to $123 billion Sing dollars. And from the key statistics of Wilmar International, their market cap right now, okay, as of 12 Jan, is $31 billion. You compare that to their subsidiary, that means it's like, Wilmar is the parent, EHI is the child, and then the child is trading at a valuation 4 times of yours at $123 billion. So that doesn't really justify the valuation of Wilmar, right? And in fact, right, if I look upon the recent analyst reports, I've taken an extract from their analyst report because Wilmar tend to share more in-depth information to the analyst. Okay, and this is what investors can focus on. So Wilmar is more likely to be open to M&As in future, and that will accelerate growth. Okay, management believes that Wilmar is undervalued because YKA market cap is now currently is already close to 4 times, and also they decided to do share buybacks, which they already have done since November 2020. And last but not least, they are exploring the listing of other businesses to unlock more value for Wilmar. Okay, so now I've come to close to the end of the webinar. So just do a quick conclusion here. Stocks. So I want to share with you my take on whether the stocks are primed for rebound. Okay, so based on the 3 macro themes, my personal take is that stocks that are tagged to these 3 macro themes will be more in a beneficial position for rebound in year 2021. And to recap, okay, these are the 3 stocks to benefit: Asia transformation to travel tech, Store Capital, very resilient and growing distributions, and of course, for a REIT to match Berkshire Hathaway's criteria is definitely not easy. Okay, last but not least, Wilmar International, they are unlocking value through the merger and acquisitions, as well as the company share buybacks. So before we move on to the Q&A, right, I just want to highlight something that we have actually a 12 months guided course for you if you want to find out how to analyze stocks like I've done just now. So this is our flagship course called the Investment Bootcamp. Okay, you can visit the link here, so bit.ly/INV Bootcamp 2020. Okay, and over here, right, in this bootcamp itself, you can get 1 year access to 600 minutes of video content over FA and TA, okay, 1 year support in our private group, 1 year subscription to the Share Investor Web Pro, 2 times members meetup. So we will meet up, we will discuss, through maybe by the online platform, we will discuss the Q&A and sharing of different stuff together with you. Then we also have the 2 times market outlook events with the industry experts, as well as downloadable course materials, checklists, and more. So last but not least, you will also get access to 2 free reports with in-depth analysis on 18 stocks. If you are interested, you can go Google this link, okay, bit.ly/INV Bootcamp 2020. Okay, so with that, I shall move on to the Q&A session. So if you have any Q&A, you can, you have any questions, you can type it inside the pigeonhole itself. Okay, with that I will stop sharing my screen. Okay. Okay, right now I'm at the Q&A session. Okay, let me just quickly browse through the questions. Okay, the first question by Bing Hua, okay, would be what are the growth sectors and stocks? Okay, in this presentation, I talk about the cyclical sectors. So if you're talking about the growth sectors, will be definitely those electrical vehicles or the 5G, upcoming 5G, and things like that. So a lot of them will be more of a US focus. Yeah, but if you're talking about the cyclical sectors, okay, that are prime for a rebound, that would be like what I've shared. Maybe those that will do well when the economy do well. So property development, the airlines, and also the tourism sectors and all that. Okay, so someone asked about the Wilma debt ratio. Okay, so Wilma um, debt is high because they have to reinvest a lot on the production facilities. They have to set up all the factories and all that before they can start to do all the oil crust refining and all that. So if you were to look at Wilma, right, it's definitely a long time play because they come up with the all the production and the food products. Not their business model is not like those tech stocks whereby they can you know increase in scale very quickly. So they are more of those very stable. You set up the factories, okay, then you do all the processes and then come out with the food products and then distribute the food products. But if you talk about the commodity sector and looking at the commodity index from the Bloomberg, right? So this will actually catapult the commodity prices going forward. So chances are that Wilma will get increased profits going forward. So, okay. Okay, Patrick asks if there's any Singapore REIT comparable to Store Capital. Okay, if I were to think about it, okay, Store Capital is unique in the sense that they invest a lot like the shop houses, okay, whereby US they don't have big shopping. Okay, they have big shopping malls, but they also have those very one-story, two-story kind of shop houses, which Store Capital is focused on. So there's no real comparables here. But if you were to focus on the industry, that would be the real retail industry. So the retail industry, you will have, the CICT, Land Lease REIT, Fraser Centerpoint REIT, yeah, and all that. Okay, so give me a sec. Let me look at. Okay, does AirAsia also face problems such as high capex, aircraft maintenance, and hedging losses? Of course, I think all airlines do face this kind of problems because predominantly they are, you have to buy airplanes which are billions in dollars. So you also have to do the maintenance work. And if you're not careful of the oil prices hedging, that will cause, significant losses. But I also want to highlight another thing is that for AirAsia, they are a low cost carrier, and the fact that they are transforming into more like a digital super app, the kind of thing, it is worth taking notice. So they are moving away from the high capex kind of industry towards a more asset light, whereby you can make your profits by this kind of super app. It's more like a you compare to Grab, it's more like a economies of scale. Yeah. Okay. So Andrew asks on the withholding tax for the buying REIT listed in US. Yeah, of course, that would be something that investors have to take note in. So US REITs, okay, or US stocks in general, when they give out distributions, investors have to pay the withholding tax of 30%. But if you're talking about something for the long run, okay, for example, Store Capital, whereby they can always increase their distributions, okay, even during a recession like the current COVID-19 situation, and you look upon it 20 years down the road, okay, 30%, although significant, but the more important thing is to look at the company that can grow their distributions, yeah, in the long run. Okay. What is my take on oil-related stocks like Keppel, Sembcorp, Marine? Okay. So for oil-related stocks, right, they are also in the cyclical sector. So like I mentioned, but for the growing trends, right, or shift in focus towards the green energy, sorry, the electrical movement, right, I see that the oil prices are not, they have a like a resistance over there. So what do I mean by that, right? Even if oil prices were to rebound going forward because the economy is going to do well, they are unlikely to become like supercharged like the EV sector is doing. So there will be a cap because many industry players, even the General Motors, Hyundai, okay, are moving towards the electrical sector. And with oil price being kept low, okay, there is uh, a possibility that it will also pose some cap on the oil related stocks as well. So that is my personal take. Okay. Okay. How will the steel industry and the stocks perform in 2021? Okay, Bing Hua asked about the steel industry. If you talk about the steel industry, generally, I would think that it will be linked to the construction, okay, and the property development sectors. So in this case, right, they will be also likely be doing good, doing well in year 2021. Especially when you talk about the BRC Asia, okay, they are a steel player, and all the construction work going on recently are likely to have higher demand for their steel products. Yeah. Okay, YCH. Okay, talk about the Wilmar ROE at all-time low. Okay, so ROE actually is the return on equity. So for Wilmar case, right, their return is low because they generally have a low net profit margin when it comes to commodities. So if you look at it, if you want to catch this kind of commodity player, right, you have to catch it when the commodity prices are low, okay, and when the commodity prices catch on the rebound, right, upward movement, that's where the commodity producers like Wilmar will take on the growth as well. So the ROE at all-time low is because of the low commodity prices, and um, you must look forward, okay, to see what is going on in the future. So that if you think that in the future the commodity prices are going up, the ROE will also go up as a result. Okay, now it's 12:58. I think I will just answer two more questions here. The, what is my comment on the recovery team in Malaysia and Singapore? Okay, the Malaysia. Okay, let me talk about Singapore first. So it's because it's easier for me. If as a consumer myself, okay, Singapore has this Singapore rediscovers voucher, and all that. I'm already seeing that a lot of people are going out, to the shopping malls. I'm already seeing people buying properties, and because we cannot fly overseas, right? Okay, people are also crowding around the retail malls and all that. So I feel that in Singapore, the recovery is already in the way. It's on the way, sorry. And if the situation, improves with the vaccine and all that, the recovery is still going to continue for Singapore as well. Okay, then for Malaysia wise, it's very hard to say because currently the government announced a MCO order, and then they also have an emergency, like order or something like that. So it's very hard for me to comment on the state of Malaysia. But from what I see, if the vaccines are working and all that, they there will be a chance, okay, like going forward, maybe in the late 2021, you will see a sharp recovery in Malaysia as well. So that will also depend on a lot of factors, which you, as investors, we have to, observe and see how they will play out in the year 2021. Okay, now it's 1 o'clock. Okay, let me see whether. Okay, let me take a look, quick look. Let me see. Okay, so someone didn't get me on the commodity demand boom slide. Okay, so okay, I just share this last question. US is printing money. Okay, when US print money, it will lead to a depreciation in US dollar. So USD will drop. When USD drop, other countries like China, like India, like Indonesia, when they buy commodities, they are paying lesser US dollar. So they will be buying more commodities as a result. And that will result in the demand boom for commodities. Yep. So I've come to the end of my webinar. I hope you have enjoyed it. Thank you, everyone.
Great. James?
Yep.
Yep, great. Thank you, James, for sharing with us. I believe we have also learned a lot from you. So the next section will start at this evening 7 p.m. The topic will be 2021年的投资大方向. The speaker will be Jack. So make sure you tune in at 7 p.m. this evening. Last but not least, you will be able to see a button like a virtual hall at the top. So we have some surprise for you. Remember to click on that. And thanks again for joining us today. Thank you, James. We will see you on next section. Thank you very much.
Thank you, Darren.
Bye-bye.
Thank you, everyone. Bye-bye.